The S&P 500, SPY, closing up 0.46% at 687.96, and the tech-heavy Nasdaq proxy, QQQ, gaining 0.47% to 622.11. A picture of buoyancy, yes. But look deeper. The small caps, the true barometer of domestic economic health, the IWM finished in the red, down 0.59% to 252.08. This is the disconnect we must analyze. The titans are carrying the index, while Main Street sentiment, reflected in small cap performance, is lagging. In the tech leadership, NVDA is the absolute star today, soaring 3.01% to 189.21. Jensen Huang's empire continues to command the premium. Apple and Microsoft are respectable, up 0.51% and 0.40% respectively, while Amazon pushes higher by 1.62%. But notice the outliers. TSLA is slipping again, down 0.65% at 485.56. A divergence in the FAANG, Magnificent 7 is signaling caution, not euphoria. This index leadership demands scrutiny. Who is driving the car, and are they looking in the rearview mirror? The market runs on narratives, and today, the air is thick with conflicting agendas and monumental ego. We have institutional drama brewing around the Federal Reserve. Donald Trump stated definitively that anyone who disagrees with him will never head the Fed. This is not subtle policy guidance. This is a direct challenge to institutional independence. Meanwhile, the opinion pages are dissecting the legacy of the current steward, with one analyst arguing Jerome Powell was, in fact, correct all along regarding rates and inflation. Which reality are the markets pricing in, the political mandate or the economic necessity? In Europe, ECB Stornaras is employing classic central bank ambiguity, stating they must preserve optionality and stand ready to move our policy rates in either direction. That's financial poetry for, we don't know what we are doing yet, but we reserve the right to shock you. Then we turn to the titans of capital. Jamie Dimon and JP Morgan signaling a formal embrace of crypto for institutional clients, a massive validation signal, pushing the legacy finance architecture directly onto the digital rails. Contrast that with Michael Saylor, who insists his strategy goes beyond Bitcoin exposure. Are they hedging, or is the narrative shifting from pure-play digital asset to diversified digital infrastructure? And speaking of infrastructure and disruption, Bill Ackman is proposing a SpaceX IPO via a SPAC merger. A private behemoth seeking public capital structure, hinting at the immense perceived valuation in the private space economy. The convergence of titans, technology, and political theater continues unabated. If you are looking for the sober reality check, stop watching stock tickers and look at the fixed income curve. This is where the institutional memory resides. The 10-year Treasury yield, the benchmark carat TNX, is holding steady at 4.17%, flat on the day. This lack of movement at 4.17%, after the volatility seen elsewhere, suggests the fixed income market is anchoring itself to a long-term equilibrium, despite the short-term noise. However, look at the VIX, the fear gauge. It ticked up 0.71% to 14.10. This means while bonds are quiet, the ambient level of systemic anxiety is rising. The market is nervous. Small caps are selling, crypto is selling, but the 10-year is whispering patience. The implications are clear. The consensus believes the current Fed stance, or the expected future stance, necessitates a 4.17% long-term borrowing cost. If inflation data later suggests the Fed will be forced to hold higher for longer, this yield has only one direction to go, sharply higher. The bond market is betting that the current cooling narrative, which we will discuss shortly, is indeed the primary story, not the political noise. We have fresh data points challenging the disinflation narrative that has driven asset prices this year. The headline news shows that US CPI inflation cooled in November. A positive reading, a relief rally signal. But our data intelligence suggests a significant warning, why it's coming back in 2026. This implies structural inflation, wage pressures, supply chain fragmentation, is not defeated, merely delayed. This structural risk is echoed in the labor market. The November jobs report showed rising unemployment and a worsening outlook for black workers. Economic growth is strong. The US saw its strongest GDP growth in 2 years, powered by consumers, but the quality of that employment growth is deteriorating. Strong GDP plus weakening labor market equals stagflationary signals masked by robust demand. The ECB's required flexibility underscores this global uncertainty. A central bank's forced to fight a late-cycle inflationary resurgence while the economy is already showing cracks in employment health. This forces us back to the bond market. 4.17% might look reasonable today, but if inflation proves sticky past 2025, the Treasury market has a long way to reset. Commodities provide tangible evidence of underlying pressure. Gold, GC equals F, is having a stellar run, pushing up another 0.68% to $4,513.50. The headline screams that gold is hitting a record to extend its 2025 rally. This is the classic flight to quality signal. When confidence in fiat policy wavers, or when geopolitical risk perception rises, perhaps fueled by the political machinations we just discussed, gold is the preferred institutional hedge. Crude oil, CL equals F, is also up 0.63% to $58.75. We have strong consumer-driven GDP growth, which necessitates energy consumption, and geopolitical overhangs keep the floor strong under oil prices. The dollar index, DXY, is slightly softer at 97.89, down 0.05%. A weaker dollar provides support to USD-denominated commodities like gold and oil, confirming that the global liquidity picture remains somewhat loose, despite hawkish rhetoric. The intraday performance confirms the narrowness of this rally. The biggest winner is clearly technology, specifically the chip makers. NVIDIA's 3.01% surge is the story. Jensen Huang's C-suite is generating new billionaires. The focus remains squarely on AI dominance. Aerospace is also flagged, flying toward record highs, signaling massive capital allocation into defense and industrial backlogs. The laggards are telling a tale of capital preservation. Small caps, IWM, are selling off. And on the individual stock front, TSLA is consistently facing selling pressure, down 0.65%. Cathie Wood continues to pare down her position, suggesting that the near-term delivery narrative may not be enough to overcome the high multiple required in this environment. A fascinating development. Larry Ellison is reportedly backing Paramount's WBD offer with a massive $40 billion guarantee. This signals consolidation and the potential for mega deals in media, leveraging deep pockets against structural industry decline. This is the cost of entry in today's market: scale or be acquired. The digital asset space is clearly under pressure today, moving counter to the general equity flow. Bitcoin, BTC/USD, is down 0.66% to $86,837.80. Ethereum, ETHUSD, is suffering more significantly, falling 1.23% to $2,926.92. This selling pressure in crypto, while modest in percentage terms, is noteworthy because it occurred while the broader equity market was positive and gold was hitting records. This suggests risk-off sentiment is selectively hitting high beta, purely speculative assets first. The institutional pivot continues regardless of the daily volatility. Larry Fink claims Bitcoin is the biggest investment this year, a massive endorsement from BlackRock. Jamie Dimon is opening the institutional trading doors. These are structural changes that transcend daily price action. Crypto is transitioning from a fringe asset to a recognized component of the institutional portfolio playbook. The dips are being treated as accumulation opportunities by the large players, even if retail sentiment wavers. The institutional conflict, political pressure versus economic reality, will define the near-term trend. We are seeing a clear rotation away from cyclical small caps, IWM, and toward established megacap growth, QQQ leaders. The implied volatility, VIX at 14.10, suggests the market anticipates choppiness, perhaps tied to external policy announcements. Tomorrow, we will be looking closely at geopolitical risk proxies and any fresh commentary from Fed members following the divergent macro data on inflation versus employment health. The breakout watch on that aerospace giant warrants attention. If industrials confirm strength, it could be the next sector to lead if tech stalls. We must avoid the consensus complacency that comes from 3 straight days of minor gains. Look at the IWM. Look at ETH. They are signaling the underlying fear. In summation, we are experiencing a market bifurcated by narrative. One narrative, driven by tech leaders and consumer spending, shows robust health. The other narrative, whispered by small caps, rising unemployment figures, and the sharp rally in safe haven gold, suggests underlying strain on the economy's foundation. The institutional embrace of crypto shows long-term conviction in digital finance architecture, but the short-term volatility reminds us that leverage remains concentrated. As Silvia Bozzoni taught us, you must connect the dots between political theater and economic fundamentals. Today, the dots connect to caution. Do not chase the top of the index. Monitor the weakness in the foundations. Stay hedged, remain disciplined.